In 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of him up till then. And there are really only 2 chapters in that book that are the key to it. But they set my philosophical framework for investing in 3 ways. They're so basic and so simple, it's hard to understand how they could be that important, but the 10 Commandments are simple. The first is that a stock is part of a business. I mean, you can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in chapter 8. There's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices. And that's what's remarkable about stocks, if you think about it, is that if you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice the low. Now that's for sound American businesses running along, paying people, selling goods, and so on. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play, except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to. In fact, one of the things I always like to do when I'm looking at investments is I like to look at them without knowing the price. Because if you see the price, it automatically has some influence on you. If you just sit down with the reports, if I get an idea about looking up a company and I get the 10Ks and so on, I would rather not know the price because I'd rather value it without knowing the price. Third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds and you're driving a 9,800 pound truck, you drive down further and find another bridge. I mean, nobody knows exactly what that capacity is, and sign may have been put up 3 years ago, so you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market. With those 3 principles, you can build all kinds of structures on that, but that's the foundation. And if you've got that in mind, and that's in The Intelligent Investor, I've never found anything that remotely compares with it. All 3 of the ones you can't get rid of one leg of the 3-legged stool and still have a good investment philosophy. But I would say that the most important thing over a long period and working with big money is to understand the business. Capitalism, by definition, is a system where every time somebody has an economic castle, somebody else is going to come after it. If somebody told me that my life depended on picking among the Dow Jones stocks a group of 10 that would be the best performers or outperform the index as a whole, I would spend my time thinking of the worst companies in there. I would cast out things, and then I would figure I left those behind, and that's an easier way to approach the problem, actually, than trying to pick the 10 best.